In this introduction, we'll focus on learning basic principles of finance and financial concepts with a focus on building our vocabulary and a strong foundation. By the end of this presentation, you should be able to define what finance is, describe how it differs from and connects with accounting and economics, and articulate why finance serves as a bridge between these disciplines for informed decision making. So, what is finance? Let's start by differentiating it from its closely related disciplines of economics and accounting. Accounting is a practice of recording or accounting for each activity and transaction of a company or individual and produces a historic record or account of what occurred. So, accounting is very historic looking in nature and focuses on reporting the business activities of the firm. Financial decision makers rely on both economic theory and empirical evidence combined with accounting data to make informed decisions for their organization. Economics is a study of how resources are allocated in a society. Economists attempt to understand the broader picture of why and how capital gets allocated to governments, businesses, and consumers. We typically separate economics into two major areas, microeconomics and macroeconomics. Microeconomics is devoted to the study of decisions by individual businesses or organizations. It helps us understand incentives and behavior, consumer choices and consumption, and concepts like supply and demand. Our understanding of microeconomics can help us in financial planning and forecasting by understanding how individuals are likely to respond to changes in a product or service's functionality, price, supply, quality, marketing, or other changes. Whereas microeconomics studies the decisions of individuals, macroeconomics examines the decisions of groups. Macroeconomic areas of study and concern include inflation, income, economic growth, and unemployment. A firm has to consider the macroeconomic conditions when making business decisions. For example, if they're considering expanding their business, they might need to consider interest rates when estimating how much it will cost to borrow funds. Or, when they're forecasting expenses and budgeting for the next year, they may need to take into account the unemployment rate and inflation when estimating the price of labor and materials. So we see finance sits at that sweet spot in the intersection of economics and accounting. In finance, we use historical accounting data as well as information on the macroeconomic environment to inform our business decisions. So why is learning finance valuable? It provides us a context and framework for empowered decision making. It can help us answer questions regarding where to allocate resources and help us figure out how to finance large purchases and assets that we can use to either grow our wealth in the future or to meet other goals. So, what is finance? Finance is fundamentally creative. It focuses on problem solving, and as a verb, it carries two meanings: to pay for or to obtain on credit. And we can think of this as two different ways to pay. We can use equity to pay for assets and investments, or we can use debt financing. So, what does it mean to finance something? We can ask ourselves, how are we going to pay for this? As we said, finance is focused on problem solving. So we have two options. We can either use money that we have or money that we borrow. And when we use money that we already have, that is called equity financing or owner financing. And on a company's balance sheet, we'll often see that ownership represented as stock. We can relate this to the balance sheet equation, where we see assets are always listed on the left, and then on the right side of the balance sheet are the two sources of capital, debt and equity. Debt is money we borrow from other people, from investors, and equity is money that the owners have put in themselves. We can think of finance as three interrelated areas. Business finance, which focuses on the financial management of a company. Investments, which focuses on different financial assets and portfolio theory, and financial markets and institutions, which focuses on the market mechanisms, the firms, the different regulatory agencies, and other players that make up our financial system. Financial management concerns the acquisition, financing, and management of assets with an overall goal in mind. Working capital management focuses on a firm's short-term assets and liabilities and how the company finances their day-to-day operations, whereas capital budgeting focuses on long-term assets And capital structure focuses on how we're going to finance those assets, as in how much equity versus debt should we use to purchase those assets. We can relate working capital management to the top portion of the balance sheet. These are the liquid assets and our current liabilities, so our bills that are currently due. And here, we focus on having enough liquidity to run the day-to-day operations and pay our bills. Capital budgeting addresses questions like, what kinds of assets should we buy to run our business or reach our goals? Whereas capital structure then focuses on the right side of the balance sheet and the financing question. What type and how much of each source of capital, equity and debt, should we use to finance our assets? To review what we've learned, finance is the study of managing money and making financial decisions. It differs from accounting and economics, but draws on both fields. The key areas of finance include financial markets, investments, and financial management. Understanding these concepts empowers you to make better financial decisions in both business and personal contexts. Thank you for joining as we embark into our journey into the fundamentals of finance.